And yet we look at oil, what's going on with oil prices right now, quite differently. We do not believe that it is an indicator of inflation. We believe it's a tax increase. It is a supply shock. That is true. The shortfall in supply. Demand has not passed where it was pre-COVID. So shortfall in supply, but it's a tax. And it's a terrible tax on the lower income groups. So we'll get into what this means and how that is actually going to feed through the system, we believe, in a moment. But I'd like to go through some of the economic indicators now. On Employment Friday, non-farm payroll came out today, and it was much higher than expected. We got the ADP employment report earlier this week, showing a decline of roughly 300,000 for the month of January. Well, this report looked nothing like that. Non-farm payroll employment was up 467, well above the 125,000 expected. So strong report. But again, you have to look through these reports a little more deeply to get the complete picture. The work week dropped 0.2 hours, which is quite a big drop. I mean, occasionally we'll see a move of 0.1, but 0.2 is a significant drop. It's a 0.6 of a percentage point drop. So 0.6, you multiply that by 12 to get a sense of an annualized rate. You know, that's a drop of 7% at an annual rate. So that was interesting. And it suggests that there probably is more weakness brewing than many economists and strategists believe right now. What economists and investors did focus on, rightly so, was average hourly earnings, up 0.7%. And on a year-over-year basis, that takes them to 5.7%. So hence the fear that, oh my goodness, inflation is now feeding into the wage structure. We believe that what's happening is the labor force has been impacted severely by the coronavirus and its variants, and things are still sorting themselves out. But one thing to note is that 5.7% is still lower than that 7% CPI. So real purchasing power is going down right now. We are seeing some indicators that are earlier in the pipeline, like the PPI surprised on the low side at 0.2%. Import prices fell by 1.8%. I mean, that would be export prices. Import prices fell by 0.2. So we're beginning to see earlier in the pipeline signals that inflation is going to come down at some point in the future. It may get worse on a year-over-year basis before it gets better. But again, we are very focused on the pipeline. What we are also focused on is that loss of purchasing power is feeding through to retail sales. So retail sales in the all-important December month were down 1.9% on the heels of a 0.2% increase in November. With inflation at 0.4, 0.5, 0.6%, those numbers, that retail sales number would, in real terms, taking inflation away, have been down 2.5%, and in November also down. So consumption is falling. Now, in the next few months, we'll probably see some sort of rebound. We most surely will, because auto sales popped up in January. We'll get into that in a minute. But we were also focusing on what companies like Facebook and Amazon are saying. Now, Amazon reported yesterday, its sales on a year-over-year basis we're up only 9%. Now, it was up against a very tough comparison. And I think on a 2-year basis, we've still got solid growth, but still 9% is even lower than the lowest point during the 08-09 crisis, which was 14.5%. True, Amazon is a little bit more mature of a company right now, but 9% I've never seen out of Amazon. And it was facing tough comparisons in the quarters prior to now, and we saw nothing like that 9%. Facebook is suggesting that for many reasons, its sales growth in this quarter will be somewhere in the 3 to 11% range. This is the lowest ever. It's never been in single digits. So Facebook has, we think, some competitive problems, but it did point to weakness in the retail sector, as did Google in its report. So consumption accounts for roughly 2/3, a little more than 2/3 of the U.S. economy. Retail sales are mostly on the good side, so that's about 1/3 of total consumption. The rest is services. So we look to the consumer sentiment surveys to give us a sense of where we're going from here. And if we did get another University of Michigan consumer sentiment survey, and it fell again to a new low, and it's lower than at any time during 2020, during the coronavirus crisis. And it is heading for lows that we haven't seen since the 08-09 crisis. So the consumer doesn't like this loss of purchasing power. We know that the unemployment rate and the employment rate are working in the consumer's favor generally, but that usually is a prime determinant of how the consumer's feeling. But it's clear loss of purchasing power is top of mind. In the survey, deeply buried in the survey, there's a part that says, or asks the consumer, is now a good time to buy a car? And I hadn't looked at this statistic in quite some time, but it has dropped to a new low, 46. It is lower than the low in 08-09, which was roughly 100. And pre-COVID, it was running at 150. So it's about 1/3 of that. And it just dropped to a new low. Now, this flies in the face of what we saw in January, auto sales moving up quite strongly from 12.4 million units in December to 15 million in January. And what we believe has happened there is the various automakers had been building up inventories at the factories or near the factories, just waiting to put in chips, as we heard all about the chip shortage during the last year. And so they are now saying that chip shortage is alleviating. So there have been people waiting for their orders to be delivered. But if this survey is right, there's not going to be much follow through. I will say that the other thing we're focused on is inventories. And in the face of the consumer feeling this way, we are paying extra attention to inventories. So for December, retail inventories went up 4.4%. Think about that. 4.4% in December, a big holiday month, after a 2% increase the prior month. Now, 4.4%, again, you annualize things to get a sense of the drama here. If this were to continue, and it won't, but, that's the equivalent of 50% plus increase at an annual rate. And nothing's growing at that rate right now. We're also seeing wholesale inventories backing up, continuing to back up 2.1%. And after a 1.7% the prior month. And in the GDP report that was reported for the fourth quarter, we saw a massive increase in inventories. So the real GDP increased 6.9%, but 4.9 percentage points of that was inventories. Real final sales were about 2%. So after a 0.1% increase in the third quarter. So real demand here is quite sluggish, and partly because real disposable personal income is falling, purchasing power is falling. Now, it appears, according to the Atlanta Fed's GDP tracker, which it changes as economic statistics come through. It appears that the first quarter GDP is going to be fairly flat. And if we had to guess, inventories will contribute to it. So I think the Fed will take due note if that tracker continues to move down. So that's it on economic indicators. I will say housing is still firm, strong. I think the great migration away from the Northeast and California, that explains part of it. Another part is city dwellers probably want that second home in the suburbs so that they have somewhere to go if and when we encounter another pandemic. Capital spending is also doing pretty well. And I believe that that's because innovation solves problems. We have big labor shortages, and the world is going digital at an accelerated rate now that we're all in hybrid working mode. And I think automation is going to surprise on the high side of expectations as companies try to counter the input cost inflation, particularly energy and other raw materials. I think innovation solves problems. That is one of our taglines. Certainly, you heard it a lot from us during the coronavirus, and we are saying it again because innovation causes increased productivity and efficiencies and creative solutions to problems that many companies are facing. Now, in terms of just one more thing on oil prices before I forget, I should have mentioned it earlier. I just saw that the shale oil production plans are up by roughly 1 million barrels per day for this year. Now, this is really important. We used to be the most important reason for the oil prices direction. Our shale oil production was the difference between rising and falling prices at one point. One of the reasons we are facing a shock in the oil industry is ESG. It is very well intentioned, of course, ESG, but as big companies are forced by pension plans who now are very focused on ESG mandates, they're forced to shift their budgets from fossil fuels to renewables. It's very difficult to ramp in renewables and really to dismantle. I mean, if oil companies stopped spending on fossil fuels in order to maintain a position in corporate pension plans and so forth, oil prices would go to the moon. Now, a lot of people laugh at the comparison to whale oil prices as we were shifting from whale oil for our lighting needs to fossil fuels. But if you look at the history, the supply shock did occur because whale oil manufacturers saw the writing on the wall and just pulled out in terms of investing. And the price was extremely volatile. I am very surprised to see oil above $90 per barrel. But that is causing a couple of things to happen here: demand destruction, and finally, especially in the private sector, private shale oil producers are now ramping back up again. The price was calling for them to do it, even 6 months ago, but they're very dependent on banks for loans, and I think the banks had been very gun shy after their experience during the coronavirus, where oil prices crashed. Now it seems like they are loaning again, and so I do believe that we are going to see a resolution to this supply shock during the next year or so. So let's go to market indicators now. Equities, as you know, they did move to an all-time high, but the internals of the market last year were not good. They were, I think I mentioned on the last In the Know, that the ratio of new lows to new highs was as high as it's been since 1999. And in 1999, it was the value stocks that were hitting new lows as everyone was racing into the internet. In this last year, it has been our kinds of stocks that were hitting new lows as value stocks were hitting all-time highs. And as you know, the right thing to have done during the late 90s, when that ratio behaved that way, was to move away from the new highs into the new lows. And I think the same is true today. And I'll just give you a sneak preview of what may happen here. I was very interested after Ford said that the demand for its F-150 Lightning EV was so much stronger than it expected, its stock exploded. Now, I want our auto manufacturers to be very successful in the EV space. But to see its stock jump to highs that it had not seen since 2000 is a sense of what I just said. What that move said to me is, oh my goodness, investors don't understand that 97 to 98% of its sales base is gas-powered cars, and we believe that the shift toward electric is accelerating here, oil prices being one reason, but also lower prices being another as battery costs come down. So I found that very interesting in the context of the juxtaposition of the late 90s against today. We're also seeing a lot of confusion in the more mature growth area of innovation. Facebook is facing real competition, and TikTok is of course the reason, and it's also under pressure because Apple is not giving it or allowing it to have as much information about users and has put in place new privacy objectives and rules. So Facebook was one of the stocks hitting all-time highs. Now, I have spoken to some really good value investors, who've been doing this all their lives, and asked them, if interest rates were to move into the 2 to 3% range, let's say as measured by the long-term treasury yield, which parts of the market, given where we are now, would be hit? And the answer that I found most interesting, and that I think we've just seen in Facebook, is it would be the more mature growth companies that are facing some competition, and not the super growth companies that are just entering into their exponential growth trajectories. So again, another argument for new growth. Think Amazon early 2000s. If you had put into a dividend discount model Amazon's revenue growth rate for the next 25 years at 20 to 30%, say 20, 25%, which is what happened. Nobody believed it was possible. Then given the way that the cash flow dynamics would have been projected, you would have bought that stock all day long as a value investor. And of course, the returns would have been phenomenal. We are in that same place with truly emerging growth right now. And the private markets know it because private market valuations have only gone up over the last year. We're writing a paper gathering the data on this right now, but in the last year, as true disruptive innovation strategies depreciated 50% or more, private market, which is which focuses on disruptive innovation, private market valuations seems to have doubled. There's really something wrong with that picture. And I think the private markets have it more right. There's more innovation taking place today than there ever has been in history. And if you take a look at our Big Ideas 2022 webinar, that we spent 5.5 hours, it's up on our site, it's on YouTube, 5.5 hours, our Director of Research, Brett Winton, and all of our analysts describing how provocative and profound these changes are going to be. I often muse that during the tech and telecom bubble, I was in the markets at that time, of course. I saw investors, falling all over each other, trying to one-up each other to get a bigger tech position because tech in the indexes had moved to 35%. So we saw many portfolios with 40, 50% tech. Again, they needed to outperform that index. And of course, that was exactly the wrong thing to do. But it was mass psychology. It was a very interesting time. Today, we have the same thing going on in reverse. We have investors shying away, in fact, running for the hills. And the hills in this case are their benchmarks. Everyone needs to get close to that benchmark. And they all look alike. If you look at the top 10 in NASDAQ, top 10 in S&P, the overlap is astonishing. These benchmarks have really, I think, done a disservice to the allocation of capital. But that said, investors are running for the hills when there's volatility, fear around inflation and interest rates. And we think that decision is going to prove to be just as incorrect as the decision to move en masse in the late 90s. Just touching on a few other markets, bonds. Believe it or not, the trend that started in the early 80s, think about that, 40 plus years of falling interest rates. That trend has not been broken. I don't think if you look at it from a very long-term point of view, it won't be broken even if rates hit 275. I'd be surprised if they hit that. But I do think the deflationary forces out there, cyclical, as I've just described, as well as secular, these innovation platforms are highly deflationary. I think that we'd be surprised to see the long-term bond yield go very much higher than here, to be honest. And then commodities, I've given you a sense of what we think on energy. I will say one other thing. This supply shock that is happening in energy because of ESG could be affecting other commodities, could be affecting other areas. And from that point of view, you could say it is inflationary. But as I mentioned with oil, the consumer is reacting violently to this loss of purchasing power. So I don't think it's going to feed inflation. I think it's going to feed this negative sentiment that the consumer has been feeling. On the innovation front and on market indicators, cryptocurrencies, Bitcoin, Ether, they have corrected with the equity markets. More and more hedge funds are involved in them. So when the market corrects, we do see higher correlations these days, although over a full market cycle, the correlation between crypto assets and any other asset is extremely low, which means for diversification purposes, crypto is a very interesting asset. In our Big Ideas 2022, you will see how we break out crypto. Our understanding is evolving, and we are able to describe it in three ways: a money revolution, a financial revolution, and a next generation internet or metaverse revolution. So if that piques your interest, do take a look at our Big Ideas 2022. I'm very proud of our research. Our research is unlike anything else you'll see out there. You will see ours because we give it away. Again, unlike most other firms, meaning we give it all away. And one thing that we are intending to do during the next few months is to put out models for various companies. These will be open source models, so you can see the cash flow characteristics of these companies. They're pretty explosive already. So this idea of profitless tech is ridiculous, just ridiculous. We're excited to share with you our models. We share our top-down models in the form of blogs. Now these actual models will come out so you can see how we're building these models and how powerful the exponential growth trajectories they are on will show through into the financials. So with that, I thank you very much, and I look forward to, everyone at ARC looks forward to communicating with you, making sure you understand why we're doing what we're doing, our conviction levels, the depths of our research, both from the top down and the bottom up. And if you are like I am, the courage of my conviction comes from our research. It is most worthy. So thank you very much. Hello, everyone. This is Cathie Wood, founder and chief investment officer of ARK Invest. I started doing these videos in the depths of the coronavirus because we were seeing an outcome far different from most others, at least as far as we could see. And that